Rory Green is Chief China Economist for TS Lombard, an independent investment research firm.
It's a significant liberalisation of the sectors available for private enterprises to invest into, and a lot of them were sort of national security sensitive, stuff like nuclear energy, electricity transmission. And there's also a big step where a significant amount of government revenue for procurement, around 40% for some projects, is going to be channeled to SMEs, which are really the backbone of the Chinese economy. So those two are very large steps. Outside of that, there's some levelling of the playing field, and it does fall short of adding monetary incentives for investment. But those two steps on opening investment and the SME side are very important.
So we know private investment in China has been slowing this year. Do you think this could help turn that around?
Yeah, I think it could certainly help. Obviously, the trade war was a big factor weighing on confidence. A generally sluggish Chinese economy as well has dampened investment appetite. And with both of those, I think, turning the corner, both on trade and a re-acceleration of the economy coming, if we add in these new regulations and incentives, we could have a quite nice impact on private sector investments.
So you've picked up a few of the challenges there being experienced by the Chinese economy, the property sector, another one. How important is the energy sector in potentially boosting things economically and improving the outlook?
Yeah, it's critical for two main reasons, Robin. Firstly, just investment into energy infrastructure is very growth positive. There's a high degree of spillovers, the materials involved, the labour cost, the land purchases. So that's one. The other factor, and this is really interesting in the new sort of AI race we're all watching, is that energy cost is a big competitive advantage for China. So the more cheap energy you have for households to use, for industry to use, and for AI data centers to use, the better the Chinese economy can perform relative to the US and to other nations. So energy investment is really critical in boosting growth and long-term outperformance.
And it's not just the energy sector China's saying it's going to open up, it's the service sector, including to US companies. What's the significance of that, do you think?
Yeah, you're right to highlight the opening to the US and the foreign investors, particularly in areas such as health, which has been quite closely regulated in the PRC. This is an attempt to bring in the rest of the world, to tighten China's links to the global economy, even as China is exceptionally competitive on the export side. So it is an important step. Perhaps more important will be domestic private sector investors who, when they see the economy starting to reaccelerate, that demand picking up, are likely to be incentivized to enter into these markets.
So what kind of indicators should we be looking out for in the coming months to gauge whether these new measures are working?
Yeah, the first things to watch are more policy signals, more politics, Robin. We'll get local government and provincial government economic plans in January and February for the 2026 year. And within those, we should see a carryover of the messaging from the state government, the state council and the central government to encourage private sector investment. And then from there, we're looking at the monthly data, pretty good data on investment by industry and by company type, private or public. And by the middle of Q2, we should have a good indication of whether these specific measures, in conjunction with an improving macro environment, have managed to turn around private sector capex.